Welcome back, Danny, and tell us how Paul blew it again.
Hey Dale, thanks for having me
Hey,
on. Just
it's
got a
great
lot of
to,
data, so
yeah,
glad we have a lot of people on the show. Good to be back on. So now that I have the ability to share, let me get that presentation for you.
okay.
Okay, is that
Yeah,
should be
we've got
visible,
it.
right?
Yeah,
All
we've got
right.
it.
Okay. The gist of it is, we have a very complicated set of policies from the Trump administration. And, the big ones have been obviously the immigration story and the tariff story. And if you look at the labor market, this is before Trump, where since 2022, when the labor market recovered, its losses, we've had a substantial amount of job gains, 6.5 million job gains, but we've also had far fewer than that in labor force gains. And so labor supply has been shrinking, has been growing less than labor demand, for quite a while. But if you look since the beginning of this year, the labor force has actually done a complete zero. And a big reason of that is the immigration story. So the chart on the right is my estimate of potential growth for the economy. And you'll notice that for a couple of years we were as high as 3%. That is actually not a normal long-term pace for the US economy, but that was as a result of the loose immigration policies from Biden. Temporarily, potential growth was stronger, which is why when we were growing at 3% in 23 and 24, we didn't overheat. Typically, you would think if we're growing well above potential growth, we would be overheating. That's not what happened. But as a result of Trump's policies, the reversal of that, not only stopping that immigration flow, but reversing it in a big way. About 1.6 million foreign workers have left the labor force. We're down to like
Wow.
1.5%. And the reason this is important is the Fed cannot do anything about this. Rate cuts cannot do anything about the lower labor supply.
Great
For
point.
example, this is my model of the monthly break-even rate. Powell himself estimates it's anywhere between 0 and 50. I have it about 30K a month. You'll see, like, under the Biden years, this was 100 to 150 at various points in time. It has collapsed to 30K. So what does that mean? It means it only takes about 30K jobs a month, if this is accurate, to keep the unemployment rate stable. And so the Fed is sitting here saying we need to cut 150 basis points. You don't need to cut 150 basis points. The last 4 months, we've grown 22K. So a little bit below that potential, break even, but not substantially below that break even. And the fact is, they really can't do anything about the fact that the break even is this low. If they cut too much, and I think they already have cut too much, then this could easily overheat fast. And I think they're not recognizing that. This is from the San Francisco Fed on the right here. And this is basically looking at the labor market from states. So bottom up analysis. And they say when 30 of 50 states, 60% of states have rising unemployment claims, that has been a good recession signal, going back, almost 80 years. And actually, last year we got close. We got really, really close, as you can see on the line there. But look where we
Yeah.
are today. We're basically at zero. So, when they look at the labor market, it's not hot. I'm not sitting here saying it's a hot labor market,
Yeah.
but it looks like they really are not in control of what is driving the labor market. And they don't recognize that it really won't take much for the unemployment rate to fall at any meaningful acceleration in job gains. And it would be very hard for it to rise substantially given the supply story. The other reason I say rate cuts are, here's my kind of theme is rate cuts are the wrong medicine. If you look at the corporate sector, you have record profits and a share of GDP. You have
Yeah.
net
Nice.
interest payments have collapsed 45-year lows in net interest payments. If take your favorite AI, go and sit and, ask them how many companies on S&P 500 earnings transcripts have said the cost of capital is too high for them to expand their business. There's not one. Nobody has said this. Nobody is complaining about the cost of capital. So why the Fed is looking at a situation of the corporate sector and saying, yeah, they need lower rates to hire people. It really is not the case at all. Rate cuts are the wrong medicine. We'll continue with that. Look at the consumer. What is their number one concern? I don't see job security in here. I don't see tariffs as a big deal for them. They don't really care about it. It's inflation.
Yeah,
45% inflation.
Yep.
By far, this is the biggest thing that everyone is worried about. And so rate cuts to fight inflation, is that how we're doing it? That doesn't really make a lot of sense, right? One of the ways that I like to look at this going back, 100 years is, we just got PCE data, and I'll rerun the numbers after. But when you look at monthly consumption and you look at monthly inflation, how much of consumption is simply inflation? And we're at 50%. That's very, very high. 60% has tend to be, when bad things happen. And we're not that far from it. And rate cuts could potentially send us up there, right? If it causes another impulse to inflation. And so I think, again, they're just missing the real story of what's going on here. Last part on this is, if, and I have to admit, I've been guilty of this. For the last few years, we saw really low consumer sentiment. It didn't really make sense. The unemployment rate is low. The stock market's high. GDP is strong. For the most part, people like me have ignored this message. But I don't think we can ignore this anymore. They are clearly telling us something, and we're not listening. And, I think the chart on the right is really telling the story. 70% of consumers think that their incomes won't keep up with inflation. And you can see how that surged to start this year, right, as a result of tariff policy. So again, how are rate cuts going to help this? Rate cuts are not going to help this. Rate cuts are going to create a new source of inflation, monetary.
Exacerbate it.
It's just going to exacerbate it, right? And so they're not reading the room, and that's why I keep saying it's the wrong medicine. Part of the reason consumers are so frustrated is that most people, if you ask them, just ballpark it in their head, real world inflation is higher than CPI. And I attempted to model this. In a few ways. One is, before 1983, they included housing transaction costs and interest payments and things like that in the shelter calculation. There's good reasons they took that out. I'm not saying they should put that back in, but it is undeniable that that is what consumers feel. And if you actually model that out from 2020, you have 20% higher inflation as a result of using that old methodology. Again, that is what consumers are actually feeling. On the right is adjusted.
It's what they're not feeling, paying, struggling to pay.
It's pain.
Their housing's 50% of their disposable, at least, isn't it? On average?
Exactly.
Okay.
But it's not just housing. If you look at this, the chart on the right is healthcare. According to the BLS, healthcare is CPI has actually stopped growing for the last 5 years, has gone flat. Nobody believes that. Nobody would, attest to that in their real life. What I did was I incorporated the fact that healthcare spending is growing 7% year over year since 2020, and we get another additional boost to inflation of about 2%. Food prices are also not accurately represented in inflation. If you do all those three adjustments, CPI would be double what it is. And that actually explains this sentiment being at, GFC levels, because it's substantially worse than what CPI is saying. Now, again, I want to say, I don't think the Fed needs to come in and, change the CPI basket to be more reflective of any of the things I've said here. That's not my job to say that. But what I am saying is I think it's hubris for them to ignore this. when, they say, oh, 3%, it's high, but it's not catastrophic. But consumers are telling you it's substantially higher. And I'll show a couple other metrics of that. Every indicator for inflation is pointing up. Here's ISMs, this is the business surveys, here's import prices coming from the dollar. All of these suggest we have a major set of inflation, coming ahead. And the Fed, in response to that is let's cut rates. Inflation expectations.
So they really baked in stagflation here, Danny, for sure. The pie is cooked. That's the point of this.
I think we may get something worse than that, but I'll leave that to the end, and I'll after I go through it all, and I'll give you the conclusion. Inflation expectations. I think this is possibly the most important set of charts that I'm going to go over, and I'll explain why. Clearly you can see they're very, very elevated. In 2022, as inflation was clearly out of control, 9%. An interesting thing was the University of Michigan inflation expectations was around 2%, consistent with 2%, 2.5%. And the reason it was down there is, the Fed had 40 years of credibility, and the Fed also responded in 22 pretty aggressively. And so they had the benefit of that, of inflation expectations reflecting their credibility and not reflecting where inflation was. Well, if you look here, that's clearly not the case anymore. And the Fed is ignoring this. In fact, I found Powell's comments last week really, really bizarre, because he was asked, what's the big worry on inflation? And the worry on inflation is that, according to him, after 5 years of being above target, inflation expectations get unanchored. Okay, I argue they are already. But even, what he says is when that happens, businesses feel more comfortable hiking prices, and households feel more comfortable asking for wage increases. Okay, how do rate cuts not directly contribute to that, right? How do rate cuts not give businesses confidence that they can raise prices further? Rate cuts are designed to raise demand. So clearly, whatever businesses are doing in response to tariffs that may or may not be transitory today will be less transitory because you cut rates. Like, it just doesn't make sense. And households, they're directly trying to stimulate the labor market. Well, what do you think will happen if the labor market tightens? They'll ask for higher wages. The very fear that Powell has is what they're enabling by cutting rates, which doesn't make sense with their reaction function.
So, all right, well, from the point of view of an economist like you, Danny, but could there be agendas that are different than mandates?
Yeah, I mean,
as to the reason.
We've seen the White House, attack the Fed. Their claim is interest payments would be lower. Obviously, they want housing to improve, and understandable, both of those. Although, of course, the Fed is supposed to have their own mandates. In fact, that's kind of what this slide alludes to. I found there's a lot of historic academic studies on attacks on Fed independence, and the most interesting thing from all of these studies, including this one, is GDP doesn't actually improve. So the White House thinks GDP will be better by the Fed cutting rates. It actually, historically, attacks on independence do not improve GDP. And I thought that was interesting. What they do is they raise inflation, and not only raise inflation, as you can see, it's for many, many quarters. These are months, right? So for up to 3 years impact to inflation as a result of attacks on the Fed. So I think the White House is just completely miscalculated, and they think there's a free lunch here. What this is showing is you get the bad stuff and you don't get the good stuff. If you got the good stuff alongside the bad stuff, okay, maybe you just make a trade-off. But here it doesn't look like that's the case. I've spent a lot of time modeling the tariffs. I used a very famous model. It's called the Gordon Triangle model. It was very famous in the 1970s. I'm not going to get into it, but if you use the Gordon Triangle model in 21 through 24. Obviously, with the benefit of hindsight, we have all the inputs to put in there now today, which weren't as easy back then. But if you have the right inputs, as you can see, this model does a very good job on both demand and supply inflation. And here's when you put in tariff assumptions, effective tariff rate of 18%, and things of that nature. Here's how it models tariffs. And I don't think anyone is ready for something like this. For a move up to a 4.5–5% range that's there through 2028. If this model is accurate, nobody is ready for this. People think it'll go up into the 3.5s and then come back down next year. But if we have something like this, then I think we're in big, big, big trouble. And that's why, again, I look at the Fed and, their response to this is to be extremely dovish. And so as a result, break evens have moved higher, inflation expectations from the market, not a lot, but they've moved higher. And real rates have moved substantially lower. Real rates are, substantially lower and below what even the Fed's estimate of neutral is. And so that's just way too stimulative, Dale. I'm a big believer in financial conditions being important. I've built models and frameworks on financial conditions to show their impact on the economy. Here's, my models, what they're saying for GDP and inflation. They're on par with 2021. Put that into context. The Fed is, they talked about financial conditions 3 years ago. They don't talk about it anymore because they know that it's gotten away from them. And, the equity market is a big part of that, the dollar as well as, bonds. And you can see that we have very sharp impulses to GDP. Well, and I'll show you the results. And then we also have very sharp impulses coming on inflation. And so they're not realizing that their too dovish stance is impacting inflation already by a big degree. We're already seeing financial conditions impact the economy. Yesterday, we got this week, we got a 20% surge in 1 month in new home sales. We'll see if that, isn't revised, but, is a substantial acceleration. We've seen a 75% surge in mortgage refinancings in 2 weeks. So whoever had a 7% mortgage, was able to lock in a 6% mortgage.
They've been waiting for that. They've been waiting for that for a long time. You knew they were.
They've been waiting for that. That frees up income for them to spend on other things, right? And we're already seeing consumer spending, which is driven by the wealth effect, the equity market, which is up 40-odd% since April lows. We had the fastest 3 months of consumer spending in 3 years. For people who are saying tariffs are going to crowd out spending. Well, the most discretionary category we have is restaurants, right? If you're struggling to pay your bills, you're not going out to restaurants 3 times a week. You're eating at home, or you're eating, fast food. You're not, if you're struggling to pay the bills, you're certainly not going out to restaurants multiple times a week. We had the fastest 3-month run rate in restaurant sales. Again, going back, over 2 years in this chart. And so what I'm concerned about, the real consequence from all this is, we hear everyone talks about run it hot and, we want to inflate the debt. And that's all nice and well, but I think the real issue is the wealthy can handle it and the lower income brackets cannot. And, in 2021, they could because wages were 7%, we're growing 7%. There were the cash handouts that Biden gave everyone. In 2021, the lower income groups were doing very well and they could manage with the inflation, even though it was obviously very frustrating. In this environment, what we're seeing is, incomes for the higher groups are accelerating, incomes for the lower groups are decelerating, and you see that reflecting in spending. And so you have the higher income groups who are doing fantastic because their equity portfolios are flying, right? Their wealth is going up on top of their income. But the lower income groups are the ones that are complaining about this. and they're the ones who are being squeezed. And so what I'm very focused on is, do we have a breaking point to all this wealth inequality story, the youth unemployment situation, the youth, surveys where they feel, the American dream is out of reach, housing is unaffordable, all of the things that they think, capitalism doesn't work for them. Do we
Yeah.
have a potential breaking point of maybe even like social unrest if we cause
I was
another
going to
wave of
ask,
it?
it's going to be more of
That's what I'm
social
concerned
unrest
about.
than financial,
That's
right?
what I'm worried about. So, in the markets, where I come back on all this is the Fed is inappropriate. They're inappropriate with their policy. And as a result, financial conditions are very stimulative. It's hard to be, bearish equities in
Yeah.
that context. It's hard to be long the dollar in that context. Although I would say, I think tactically in the short term, we could have some more of those. Like, we could have a little bit of equity pullback and we could have a little bit of a dollar rally, but it's hard for a sustainable dollar rally if the Fed is going to continue cutting into this. Now, at the same time, from the data that we've been getting is extremely strong, like what we got yesterday, what we got with retail sales last week. And even today, early morning, we got very strong spending and income numbers. We'll have to see, is the data going to pull the Fed away from all this? Because what did I show here? Housing is improved, consumer spending is improved. The last shoe to drop would be, a better job report or two. And if that happens, the Fed backs off, right? So
Hey,
that is
hey,
what I
Danny.
think.
Danny,
Yeah,
this
I'm
is
comfortable.
Blake. I wanted to ask you a
Like,
question, and nice to meet you, and great presentation thus far. If everything you talk about as far as inflation and it's too hot, Fed's inappropriate, and you're talking about subject matter that I believe is on point. I hear a lot of people discussing a lot of the same inequality, the wealthier carrying the load and everything else. But let's go back to the Fed really quick. A narrative that isn't discussed a lot today, which was a couple years ago, is going back to the early 70s when I was a kid, and Dale remembers this, when the Fed started to cut rates. The economy was running too hot. They had to actually start rate. They cut rates and then they had to start raising rates again. We were, in retrospect, in the middle of a recession, or going into a recession in the early 70s, and it was during the oil shock. They had to raise rates again. Do you think that's what the Fed's going to have to do? They're going to have to pivot and to cool off the economy if inflation isn't calming down. The employment picture is still relatively strong. Economic data continues to run fairly hot. Is the Fed going to have to raise rates again versus cutting rates where the market's pricing it? Because that's where that disparity, that reversal of expectations is what really moves the market, which we all live in. But is that what we're going to be facing moving forward?
Will the
I
Fed
think they
reverse
will.
course?
I think they will have to, but the really hard part is, will they? Because they will be politically captured by Trump.
Yeah.
And
Yeah.
Sure.
that's the
All right.
challenge. So I mean, I think, the candidates being proposed for Fed chair, like Waller, or Warsh. I think if inflation really is, 5%, they will be hawkish.
Yeah.
But I don't
Agree.
know if instead, if they put someone like Steve Moran, if it'll just be a complete cartoon show, a
You
clown show.
mean like Arthur
And
Burns?
what he did with his dot plot and how he justified it in the last week, anyone who's followed him on Twitter for the last few years knows that it's a disingenuous view. Like, it's not
Yeah.
his views are strictly political. They're not really economically driven, because he's done a full 180 on multiple topics, and he's basically just trying to find data to back into what Trump wants. And
Well,
so
and
if
and that's why
if
no,
he's
no
Fed
nobody
chair,
from nobody from the governing council jumped on his bandwagon. I mean, it was obvious when he was the only dissenter. If it was really, if he really had a case, they would, and it was more politically driven. Yeah, but the Fed loves its independence here. I mean, wouldn't you agree with that? They're fighting
Yeah,
for
but
their
they're still
independence.
talking about cutting. They're still talking like, okay, again, go back to this. Powell himself knew that the break even is between 0 and 50K. So even if it's at the higher range of what I estimate, I say 30, but he says, let's just say it's at the higher end and it's 50. It really wouldn't take much for the job market to get back to those type of levels, right? Like, the markets are doing well, the GDP is quite strong. Labor market is the one thing that isn't. Okay, you give it a little bit of a boost, that's fine. But they're still in their dot plot projecting cuts all the way to 3%. And so, that's from 4.5, that was 150 bips of cuts. And, clearly you don't need, if your break-even level of employment is that low, you don't need that much to get it to a little bit better pace than what it currently is. And so I think that's the real, challenge here is I'd like to say the Fed would be responsible in that situation that you're outlining, the situation I'm outlining, but I don't know that they will be. We really don't know that. We know for sure if Moran is the chair, he's going to be pushing for ridiculous action. You're right. Maybe the committee doesn't go along with it. We've never seen something like this where, actually, we did once. Volcker
Arthur
had
Burns. Arthur Burns.
We had, well, the committee went along with Arthur Burns, but with Burns made mistakes, but the committee went along with it. There was one point where Volcker wanted to tighten and the committee did not, and Volcker pushed it through. So do we have a situation where like Chair Moran pushes rate cuts as inflation's going up? And we may have a situation like that. No one really knows how that plays out next year. But I do believe that with financial conditions as easy as they are, that the impulses to the economy are very strong, that we're more likely to see unemployment rate go substantially lower than substantially higher. On the middle ground, could it go up another 0.1? Yeah, I can't say it can't do that. But I think we're more likely to see it go substantially lower than go to 5% per se. And I think, the issue is, again, they're projecting a lot of rate cuts, and that themselves doesn't seem appropriate. If they had come out and said, we're doing one cut, it's like he did say insurance cut, whatever, we're doing one cut, but they didn't have a dot plot that showed 150. I think, maybe that would be a little bit more reasonable for as a reaction function. But I do think they're going the wrong way. I just don't know if they'll have the stomach to reverse it, by next year. It's really hard to bet on that. It's really hard to say.
Could the market reverse it? There's those guys, those bond vigilantes. Could they make the Fed reverse by just not buying treasuries? And is the market going to be bigger than what the Fed is doing with rates? If they see the same thing, huh? Go ahead.
So far, we're sort of paralleling what sort of parallel to what happened last year. They cut rates, and since then, yields have gone up pretty consistently. And equities have started to wobble a little bit over it. Not a big correction, 1%, but they've started to wobble a little bit over it. And I think what we've seen in again, I'm going to go back to financial conditions, which is a big focus for me. I call it the financial conditions loop. If you follow me on Twitter, I talk about it all the time. The first shoe to drop with financial conditions is housing. It tends to react within weeks. The purchase index, the refinance index, you see a reaction within 2 weeks of a sharp drop in interest rates every single time. So housing is first, and then within a couple months, you get something like a pop in sales. You don't usually get this big a pop in sales, but you usually get some kind of 5 to 10% pop in housing transactions. The next thing that you get is via the wealth effect, you get higher consumption. And then with a delay, what you get is better labor outcomes, and then then you get inflation. Inflation lags. So when I look at financial conditions as loose as they are, it seems like if we get a decent payroll report, let's just say we get a 75K payroll report, that is well above the break even. The unemployment rate would go down a touch. If that happens, given all the other data we've had, bonds could easily go back to 450, 460. I'm talking the 10-year. Easily could go back there, and that could hit stocks.
That's my target.
Right? Stocks.
Yeah,
it could hit stocks. The dollar would rally. Maybe we would have something like that. Every single one of these episodes, equities have gone first, bonds have gone last. Bonds have gone last. Bonds wait for the data to actually come in strong before they react, whereas equities have tended to go ahead of the data. Equities have, April 10th or 11th or whatever the bottom was, have never looked back, right? They have never looked back since that point. They have just gone straight up since then. They clearly, said the event is over, the uncertainty is over, the impact on the economy is over. I'm gonna come back on the not sharing anymore, but and they've never looked back. It's bonds that are always late to the party from a financial conditions standpoint. So I think it's very possible that we get a major bond market correction out of this because we just overdid it on the rate cuts, as we have 5-6 times before the cycle.
Okay, Danny, great presentation. I hope millions of people hear this. You got to get it out. I've heard people talk about the Fed making a policy error, but have never seen it laid out this way with all the different factors. You're definitely an economic intellectual, and you made it simple for us to understand. Appreciate it. That was great, bro.
Thanks, Dale. Thanks for having me on. It was great to be on again on your show. I love it, and we'll have to do it again soon.
All right. So best way for people to stay in touch and follow your work and get your you have a letter, you have a Substack. What's the best way for them to go about that, Danny?
Sure. So my Twitter handle is DannyDayan5. You can find me there. I'm posting sarcastic comments almost every day. Hopefully you find them entertaining. And in the link in my bio, you have a link to Macro Musings by Danny D, where I do detailed analysis like we just went through on a regular basis. I have weekly notes. I also have very deep macro thematic notes. As well as trade ideas and everything of that sort. So check it out, and look forward to the dialogue there. Thanks again, Dale, for having me, and I hope you have a great weekend.
My trading warrior brother, Danny Dayan. Follow him, make him part of your intelligence gathering. I guarantee you this, you'll be more intelligent. Okay, so thanks, Danny. Have a great fall trading season.
You too.
All right.
Take care.
All right, buddy. So that's a wrap, everyone. We made it. Have a great weekend. Don't just count your pips, count your blessings. You know the drill. So, yeah, you too, Sinatra. All right, Mark. See you guys. Blessings to everybody. I hope they overrun you like a tidal wave. See everyone next week.
Hey traders, this is Blake Morrow with Forex Analytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.